Hello there, finance enthusiasts! And a big welcome back to Investing Lighthouse, your treasure trove of investment wisdom. Today, we're all set to embark on a remarkable journey, decrypting the sage wisdom of none other than the Oracle of Omaha, Warren Buffett himself. Buckle up as we unfold 12 of the biggest blunders investors tend to make, as per Buffett, that you must avoid to ensure your financial journey is smooth sailing. Will you see yourself mirrored in any of these mistakes? Stay tuned to find out. It's a journey of self-discovery as much as it is about learning from others' missteps. First up is the pitfall of overactivity. Yes, the stock market can be exciting and it's easy to get caught up in the thrill of it. But remember, patience is a virtue. Overtrading often leads to impulsive decisions, raising unnecessary costs and potential losses. Picture day traders frantically buying and selling, incurring a mountain of transaction fees, only to end up at square one. As Buffett says, the stock market is a device for transferring money from the impatient to the patient. So let's learn to sit on our hands a bit. Next, we address the mistake of holding on too tightly to your initial purchase price, also known as anchoring bias. It's easy to hold on to stocks, hoping they'll bounce back to the price you paid for them. But remember, the market doesn't know or care about your purchase price. The important thing is the stock's future prospects from this point on, not what you paid for it. As Buffett sagely advises, our favorite holding period is forever. However, he does not imply holding on to a stock that's lost its value and potential. Letting go can sometimes be the best investment decision you make, folks. The third trap to avoid in investing is setting aggressive growth projections. Being overly optimistic about future growth rates can lead to overvaluing stocks, increasing the risk of disappointing returns. Understanding that only a few companies can sustain rapid earnings growth for years is crucial. Some businesses have impressive growth bursts, but maintaining this pace is not easy. Why is this? It boils down to competition, market saturation, and the law of large numbers. Successful companies attract competitors who want a piece of the profitable pie as they grow. And the larger a company becomes, the harder it is to maintain high growth rates. In the wise words of Warren Buffett, forecasting rain doesn't count. Building arcs does. This means that rather than constantly trying to predict and chase growth, preparing is more important. This could mean selecting investments poised to weather various economic conditions, understanding the company's competitive advantages, and being realistic about growth projections. Have you ever caught yourself getting so caught up in the details that you lost sight of the bigger picture? Perhaps you're so focused on the company's latest quarterly earnings that you fail to see the structural problems slowly sinking the ship. It's essential to take a step back and look at the overall health and prospects of the business. As Buffett says, you can't see the forest when you're knee-deep in trees. Fifth on our list is the risk of using excessive leverage. Borrowing money to invest can amplify returns, but it can also amplify losses, leaving you in debt. This risk becomes particularly acute during an economic downturn or market crash when you might be forced to sell your investment at the worst possible time to repay your debt. The key point is you could be right about your investment thesis, but if someone like your broker or the bank pulls the plug on you during an economic collapse, you will go broke before the market realizes you were right. Now, onto a mistake that even seasoned investors can fall into: overcomplication. Or, as Buffett puts it, trying to jump over a 7-foot bar. In the world of investing, Attempting to decode the complexities of certain investments may seem like a path to more significant returns. But here's the reality check. It's not. Investing doesn't have to be complex to be successful. It's often the straightforward investments that stand the test of time. So, next time you come across an investment opportunity that seems too convoluted, consider this. Maybe the bar is set too high. It's time to lower the bar and embrace simplicity. It's not about how high you can jump, but how steadily you can grow. Next up, don't limit your opportunities. Buffett's advice is to avoid creating arbitrary restrictions, limiting your potential investments. The broader your universe of opportunities, the better your chances of spotting a gem. As he says, in the business world, the rear-view mirror is always clearer than the windshield. The eighth blunder on our list is succumbing to herd mentality. Following the crowd is like being a lemming jumping off a cliff because everyone else is doing it. Just think about the dot-com bubble, where investors followed the herd into disastrous investment decisions. Remember to do your research and make your own decisions. Buffett's take on this? Be fearful when others are greedy, and greedy when others are fearful. Diversification is protection against ignorance. It makes little sense if you know what you're doing. These are the wise words of Buffett himself. Diversification is a sensible strategy for those without the time or inclination to research and understand their investments thoroughly. It spreads the risk and lessens the impact of one poor-performing investment on your overall portfolio. But for those who are engaged and who take the time to thoroughly understand their investments, spreading their capital across a vast array of stocks can lead to mediocre results. Why? Because each investment gets a smaller portion of the capital, which could lead to lower overall returns. It's crucial to remember, though, that with fewer investments, each choice must be well researched and carefully considered. After all, there's a thin line between confidence and recklessness. Be like a sharp-eyed eagle, focused and precise, choosing only the investments you fully understand and believe in. Are you only listening to opinions that confirm your own beliefs? That's confirmation bias, and it's a dangerous path to tread. Like an investor who only reads bullish analysis of their favorite stocks, dismissing all opposing viewpoints. Open-mindedness and adaptability are crucial in investing. Make sure to actively seek out opposing views and consider them with an unbiased mind. Remember Buffett's words, "What counts for most people in investing is not how much they know, but rather how realistically they define what they don't know." Our penultimate mistake is the cost of omission. It's not just the wrong investments that can hurt you. It's also the right ones you fail to make. Don't let fear or indecisiveness hold you back. Buffett suggests, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. Finally, according to Buffett, the cardinal sin of investing is trying to time the market. It's virtually impossible to predict market movements accurately and consistently. Investors who try to predict market peaks and troughs often miss out on substantial gains, all because they're waiting for the perfect market conditions. It's akin to an eagle-eyed surfer waiting for the perfect wave, only to watch a sea of good ones pass by. Take, for instance, those investors who kept waiting to invest during the 2008 financial crisis, hoping for the market to reach its absolute bottom. But once the market started recovering, they were still on the sidelines, missing the initial strong rebound. This is why Buffett urges us to shift our focus from market timing to identifying high-quality businesses at reasonable prices. And there you have it, folks. The 12 cardinal sins of investing, according to the great Warren Buffett. Don't forget, investing is a marathon, not a sprint. Steer clear of these pitfalls, and you'll be well on your way to financial success. What do you think about Buffett's advice? Have you been guilty of any of these investing mistakes? Share your experiences in the comments below. If you enjoyed this video, show us some love by hitting that like button. And if you haven't already, subscribe to our channel for more insightful investment discussions. Happy investing, everyone!